Okay. Okay, so this is the introduction, and then I'll be able to talk about financial statements, how they're created. And module 6 and 7 were about financial statements. I'll be talking about financial statements with graphic arts. Now, I'll go over a startup company, which will show you how it raises capital, and then how later on, if they want to expand further, they need to get further investments like venture capital. Within this story, I'll talk about the black balance sheet, which is like a snapshot of the condition of the company. I'll show you the three kinds of cash flows. And then I'll show you the J curve from break even to profitability, the J curve. So let's go into the birth and growth of a company, the startup. The startup is a young company that is based on this idea, this entrepreneurial concept of putting up air-cooled shoes. As you walk, it cools itself. So that's how the entrepreneur sells it. And then he might even later sell a similar product like the air-cooled jackets. And when he has a business idea, he then brings it to life and then raises the money. He raises the money, first his own money, owner's equity, and then the money of investors like angel investors, for example. And then he might even borrow money from the banks or from other investors, loans, also known as debt capital. So the raising of the money is part of the financing cash flow. All right. And then later on, when he pays off the debts or gives money to the equity owners, then that's also part of financing cash flow. It's a cost of financing. And then when you start to buy machines and factory, that's already the investing cash flow. And then when you start to buy raw materials, pay rent and wages, that's all part of the operating cash flows. All right. Now, the first cash flows are at the bottom. You raise capital and put up your owner's equity. And then you need additional capital. You might need to speak with angel investors who are kinder and they're willing to help you succeed. And that's why they're angel investors. They don't need a return of their money right away. They're willing to give you every opportunity to prosper. And with that money, you invest in factory in machines, and then you also start buying raw materials, start producing the product, selling, and then collecting. That's part of the cash cycle, which is part of operating cash flows. So you start by, with your 5 million, you buy raw materials, and then you make finished goods. Your sales should be about 20 million. And then your collections could be immediately 15 million out of the 20. Later, you collect the remaining 5 million. So you have 20 all in all. And with 20 million, you can buy more raw materials and build more finished goods or produce more finished goods. Let's take a look at the relationship between sales and profits. Now, the sales are moving up all right, meaning they're moving from 20 to 30 to 42. That's good. That's healthy growth. And also the profits are moving up from 5 to 10 to 15 million in profits. That's also upward moving net profits. That's good. We can learn a lot more from studying the percent growth from 20 to 30 to 42 million on sales, and check also the percent growth of the profits from 5 to 10 to 15. What's the average growth rate? We can also learn a lot from dividing 5 divided by 20, 10 divided by 30, 15 divided by 42. That tells you the net margin. How profitable is the company? Is it a product where you can charge a high price? All right. So how do you find that out? You divide 5 over 20, profits over sales. You should get 25%. 9 over 30, you should get 30%. 15 over 42 should get 36%. So even the profits over sales is moving up from 25 to 30 to 36. That's good news. They're getting more and more profitable. So that's one way of reading the financial statement there. That's going to come in very useful when you're analyzing for profitability. What if you need more machines and factory to increase production? One way is to keep improving your operating cash flows, like buy more raw materials, produce more finished products, and then sell and collect, right? If you need to raise it a higher level, like you need 2 factories, 3 factories, you'll need more financing cash flow. And when you raise the financing cash flow, invest it into the factory. So you have 2, 3, 4, 5, 6, 7 factories. That's how you have more financing cash flow and more investments. Investments are the machines and factory. So you'll have a higher level of operating cash flows. And then later on, you'll have a higher and higher level of operating cash flow, thanks to the additional machines and additional factory. Yes, you can produce more. So here's a diagram of your cash cycle. Tells you that you start with 5 million of raw materials, you end up with 20 million in sales. And you can do that once because you only have 1 factory. But the moment you have 2 factories, you can do that twice, of converting the 5 million to 20 million. And how can you get 2 factories? If you raise the money, that's called financing, and then therefore invest in an additional factory, that's called investing cash flow. So in the middle, you have 2 cash cycles of 5 moving to 20 million, 5 million in cash, moving to sales of 20 million. Over on the right side, you increase the financing by raising more capital and invest it into a 3rd factory. So therefore, you will have 3 cash cycles operating. The 5 million converting to 20 in sales, 5 million in cash converting to 20 in sales, 5 million in cash converting itself to 20 million in sales. So 3 cash cycles will give you more operating cash flows. But to make that happen, you needed to have additional financing cash flows. And the moment you get the money, invest it in machines and factory. That would be your investing cash flows. Right? So at the start of the whole program, you need to really raise financing. And then when you invest, you have more factory, more machines, then you have a higher level of production. And then at some point in time, you can take a medical checkup once per quarter to see exactly how much assets do you have now, how much liabilities at that point in time, and how much is your current assets and fixed assets. Then you have operating cash flows moving across time. You measure that over time. And then you check again what's your additional need for financing, additional need for capital. You might need more capital. And then by the time you take another snapshot of the company's financial condition, you will have more assets because you raised more capital from the financing exercise, raising equity or raising debt, getting a loan, for example. And that's how you will have more machines and factory and more operating cash flows. And you can keep on increasing this cycle forever as long as it's still a profitable company. Next, let's take a look at the balance sheet. Is simply a snapshot in time of how much money you have in the company. Of course, the money in the company is produced by the cash flows, the money that you raise, the money that you employ, the money that you put into machines and factory. But when you take a snapshot in time, that's when you see how much machines and factory you have, how much assets and liabilities. So the balance sheet is taken every 3 months, 6 months, 12 months. Okay, and then after, you'll also see, as part of the operating cash flows, you'll see your profit and loss statement. Okay, so let me start over again and and show you that the normal company starts humbly with your own money. That's called owner's equity. And then the newly born firm needs to break even because you start money, you start investing money, you're still in the red because you have invested, but you need to get that money back and break even, and then start having profits and positive cash flows. If you need more money, aside from owner's equity, you might need to borrow in the form of liabilities. Current liabilities would normally be bank loans, meaning they need to be paid back within the year. And all of those can be coming from banks or angel investors. A lot easier if you can approach angel investors because they are more willing to risk their capital than are the banks. After some time, you will have a balance sheet that looks like this: fixed assets lower left, current assets upper left, upper right current liabilities, and then you have your long-term liabilities in the middle, and finally at the bottom on the right side would be your owner's equity. Okay, so this is at least American style, US style, Philippine style. This would be the appearance of a balance sheet. And then your J curve keeps moving up, and you keep on, I hope, getting more cash, more sales, more profits, more cash, more sales, more profits. And that's why I portray the J curve as eventually breaking even and rising, maybe not in a straight line, but maybe a wavy line. So that's the reality of life. Sometimes the business grows in high speed, low speed, stagnant, high speed, low speed, and then stagnant again. So it's like a wavy pattern of improvement over time. Ultimately, you're going to be a medium-sized company. The small company becomes medium-sized, and eventually it becomes a big company or major player. Right? So you started up the business, you raised capital. With the help of your good marketing and your good operations, you keep adding to your cash hoard because you keep converting the 5 million in cash into 20 million of sales. With good strategy, you grow and expand. Maybe you grow citywide, maybe you grow nationwide. And then after a while, you become a major player and you can start merging with other companies of your industry or acquiring companies which are subordinate to you. Okay, so all of that comes together. The finance, the marketing, and operations give you sales, net income, cash flow, return on investment. The big bosses will have to think about the strategy moving forward so that you can keep this going. Ideally, keep it going for as long as you can. If necessary, change the strategy so that you can still make a product that people want to buy. So if your product becomes obsolete, change it. And then you become a major player. If you face stiff competition, then you might have to think carefully about changing your product line or moving into another industry by acquiring a company in that industry or selling off your most profitable companies and moving into something that's, again, another J curve. It depends on how you read your strategy, whether you are going to really move from strength to strength. And if you fail to do that, if you don't move from strength to strength, but you make some mistakes, then you might have to be breaking up the company and disposing of some assets. So, too bad. At this point, let me tell you that there are some sources of funding which are easy to access. The ones on the right would be more difficult to access. You have to justify your plan, your project to the potential buyers, potential investors. Okay, so after some time, more capital can help you to move from small to medium size. And then after you do reach medium size, then you can be a client for an investment bank. Right? So after discussing the startup, let's talk about expansion with venture capital. That would be additional money for building in new sites or additional money for putting out a new product line or additional money for going nationwide until you finally have profits. And once the company is not just having sales, but also profits, meaning the sales are bigger than the costs. Then when that happens, then you already have profits and you can be attracting investment from private equity funds. They invest in companies which are already profitable, already proven, and then they have a potential, these companies have potential to go IPO. Okay, and then when the company goes IPO, then they can qualify for bank loans more easily. They can qualify for stock market listing, IPO. And then you can expand and diversify further. So here's the summary of the funding sources on the equity side. There's angel investors at the beginning, then venture capital. They do coach and mentor the investee companies that they own. And then there's private equity. Late stage means it's close to IPO. They monitor and evaluate your progress, give you management tips. And finally, the biggest equity capital that you can raise would be from IPOs, initial public offerings, and possibly also from private placements, meaning less than 20 investors would, if you can raise the money with from less than 20 investors, you can call it a private placement. Otherwise, if you're raising money from more than 20 people, you should call it a public offering. If it's the first time, of course, initial public offering. It can be a follow-on offering if it's the second or third time. Okay, thank you very much for your time. Let me share.